Ladies and gentlemen, good day and welcome to the MAS Financial Services Q4 FY24 earnings conference call hosted by DAM Capital Advisors Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sanket Chedda from DAM Capital Advisors. Thank you, and over to you, sir.
Yeah, hi. Very good afternoon to all of you, and a warm welcome to the call to discuss MAS Financial's Q4 results. We have with us entire senior management on the call today. Mr. Kamlesh Gandhi, who is a chairman and managing director. Ms. Darshana Pandya, who is director and CEO. Mr. Ankit Jain, who is a CFO, and other senior management team as well. So without further ado, I'll hand the call over to Mr. Kamlesh Gandhi for the opening remarks, which we will follow up by question and answers. Over to you, sir.
Thank you, Sanket. Thank you, Sanket. And good afternoon to everyone. Happy to connect to all of you once again to discuss the 116th quarter of our consistent financial performance. So, friends, 116th quarter is a very long time, and happy to share with you that we have been in a position to perform very consistently over all these years, and God willing, will continue to do the same in the future also. Just to give you the information on few of the important milestones that we crossed in this year. So while you can never be satisfied, but we are quite happy to cross certain milestones. Namely, as shared with all of you, we crossed a very important milestone of crossing 10,000 crores last year. We got upgraded to, we got our rating upgraded to AA minus from CARE. As such, it was little overdue. And at another important milestone, we crossed 250 crores in consolidated profit after tax. So these are few of the important milestones we crossed, which will lay a very strong foundation for the decade. As all of you know that when we meet, I always share with all of you that at MAS, for us, decade is a medium-term view, and we never take a short-term view, and hence we are in a position to concentrate on the fundamentals and have demonstrated this robust financial performance over all these years. While my colleagues will take you through the detailing in number, if I just take you through few of the strategic things for this quarter, is that the growth translates to a 26% in AUM and 23.41 in PAT in consolidated basis. On a standalone basis also, we grew at around close to 23% in AUM and PAT. As far as our housing finance company is concerned, and I think all of you might remember that we were have been giving the guidance that this company is now on cusp of delivering robust results, and very happy to share that we could grow this quarter at a very robust 44% this quarter. Having said that, we got good opportunity to grow at 44% this quarter, but the guidance remains in the range of 30 to 35% growth, which we'll try to surpass. So from the housing front also, we could register a very robust growth on AUM profitability, very importantly on the quality of the assets. As I talk to you, our quality of asset in our parent company is a gross stage 3 assets of around 1.51%, holding on a buffer provisioning of another 0.24%. In our housing finance company also, the quality of asset is very benign. That is the net stage 3 of close to 0.6%. Capital adequacy at a very comfortable or at a very fundamentally strong levels of close to 24% in capital adequacy, with close to 21% in Tier 1 and the rest in Tier 2. Housing finance company also with a very robust capital adequacy of more than 38%, where we get the advantage of a lower risk weightage being in the affordable space. The other way to look at it is the leverage. Leverage remains at a very comfortable leverage of around 4 in our parent company, and the same in the case less than 4 in our housing finance company. So all in all, the development for the entire year has been in sync with our understanding of all these years of running the business, of making a fundamentally strong business. Where if I talk about ROEs at around, on a yearly basis, at around 16.5%. The last quarter registered a ROE of 16.98%. So we have been advocating that we are a company which will endeavor to grow anywhere between 20 to 25%, maintain ROEs in the range of 15 to 17%, a very strong self-propelling capital model. Having said that, we have an enabling resolution to raise capital whenever we require. As I shared with you last time, we have an enabling resolution of 700 crores. I met few investors in the last quarter. We'll be meeting few investors this quarter also. But we would take our own time and we'll decide and select the right set of investors who can align with our objective of consistent performance, and in our belief that consistency and steadiness is the best way to reach your destination. In terms of our distribution, I think we have consolidated on our direct distribution substantially. Our RSA distribution has also consolidated, while as I've shared a number of times that our direct distribution will grow at a faster pace as compared to our indirect distribution, and hence this, as I talked to you, we are at around 68-32 ratio in favor of our direct distribution. Going forward, we see that settling anywhere between 70 to 75 in favor of our direct distribution. This is in line with the guidance we have been giving since few quarters, and very happy to share that we could achieve those guidance. In terms of the assets we serve, we've still driven predominantly MSME funder, around 80% of our business coming from MSME, and the rest coming from Wheels, and less than 6% coming from our SPL business. Housing contributes a modest 6% currently, but going forward with the type of growth trajectory we are anticipating, it should also contribute very meaningfully to the overall assets of the company. On the liability side, as I shared and Ankit will share in detail, we are well capitalized, and as usual, we have a very strong debt line. Almost we have tied up for till Q1, or say to an extent for Q2 also, as I talk to you. And with rating upgrade, we'll have more opportunities to tap more avenues, and also in the medium term reduce our cost of borrowing. On operations, we continue to embrace technology adequately. We are a company which is having our own technology team in-house. We have one of the most strongest LMS as far as LMS is concerned. We have developed LOS for all our systems, and we are embarking on core banking also. We have set up a team at Mass to look after core banking, and within few quarters, I think we'll be in a position to share the progress on that also. And our team remains a strong team of 3,700 people with a big team of collectors succeeding and failing together, has held us in a good state with more than 550 people now with us for more than 5 years. And obviously the co-owners of this company, the core team, which has been with company for ranging from 15 to 25 years. So that forms a very formidable second line of action, second line of team, with Dhwani also from the promoters group quite active, and he will be completing his decade this July. He joined in 2014. So with this remarks, rather than taking much of your time on this commentary, which many of you know, I will hand over to my colleague Darshana. She will take you through detail in numbers, and then to Ankit, and then we will be open for Q&A. Thank you.
Thank you, sir. Good afternoon, everyone. So we are very happy to share that in the last quarter we crossed a very important milestone of 10,000 crore on consolidated basis, and this quarter we have crossed this milestone on standalone basis. So if we look at the consolidated numbers. Our consolidated AUM as on March 24 is now 10,722 crore as compared to 8,506 crore last year. And PAT for the year is 254 crore as compared to 205 crore, which is 26% growth in AUM and 23.37% growth in PAT. If we look at the standalone numbers, starting with the breakup of the AUM, our MSME portfolio is contributing 80%. 4,385 crore is a micro enterprise loan. SME loan is 3,734 crore. Wheels loans are contributing around 14%. 670 crore is two-wheeler loans and 748 crore is commercial vehicle loans. And salaried personal loan is 588 crore, which is 5.8% of the total AUM. That is 25.12% growth in standalone AUM. If we look at the total income on quarterly basis, it is now 329 crore. Last year it was 268 crore. This is 23.04% increase in total income on quarterly basis. Profit before tax has increased by 29.37% on quarterly basis. Last quarter, Q4 23, it was 70 crore 41 lakhs, and this Q4 is 91 crore. Profit after tax has increased by 22.50% from 55.55 crore to 68 crore this quarter. If we look at the yearly number and on annual basis, total income has increased by 30.29% from 940 crore to 1,225 crore. Profit before tax has increased by 25.21% from 265 crore to 331 crore. And profit after tax has increased by 23.28% from 201 crore to 248 crore. So this is the financial numbers. If we look at the portfolio quality as shared by Sir, our gross stage 3 is 2.25% and net stage 3 is 1.51%. In December quarter, it was 2.23% gross stage 3 and 1.48% net stage 3. Now coming to our housing finance performance. Now our portfolio in housing finance is 596 crore. That is 44.26% rise in AUM. Last year it was 413 crores. Total income has increased by 42.58% on quarterly basis from 12 crore 40 lakhs to 17 crore 68 lakhs. Profit before tax has increased by 54.21% from 1 crore 70 lakhs to 2 crore 62 lakhs. Profit after tax is 51.55% rise from 1 crore 37 lakhs to 2 crore 8 lakhs. And if we look at the annual numbers, increase in income is 42.75% from 43 crore 75 lakhs to 62 crore 46 lakhs. PAT has increased by 18.31% from 8 crore to 9 crore 58 lakhs. That was PBT, and PAT has increased by 19.48% from 6 crore 34 lakhs to 7 crore 58 lakhs. Here also the portfolio quality is very stable. The gross stage 3 asset is 0.90% and net stage 3 asset is 0.66%. In the last quarter it was 0.81% gross stage 3 and 0.58% net stage 3. So this was about the performance in our housing finance company. Now I'll request Ankit to brief you about the liability management.
Thank you, ma'am. Good afternoon all. To elaborate on the capital and liability management, the company through its efficient liability management was able to maintain an average liquidity of around 800 crore during the quarter and unutilized cash facility of rupees 575 crore. In addition, the company has sanction on hand to the tune of around 1100 crore, which will fill up the requirement in the coming quarter. In the March quarter, company did around rupees 600 crore direct assignment transaction. The company further has around 1,000 crore sanction on hand, which will be utilized during the quarter and next year. The off-book portfolio is around 22% of the total AUM. We as a strategy aims to maintain around 20-25% of AUM as off-book through direct assignment and around 5-10% off-book as co-lending. The company has available cash flow facility of around 1,700 crore, out of which we maintain utilization level of 70-80%. This portion is kept as liquidity buffer. We raised around 890 crore term loan during the quarter with an average maturity of 3 to 5 years. This helps us to further strengthen the asset liability maturity pattern. We are strongly placed with respect to structural liquidity for the period ended 31st March, and thereby the liquidity is adequate and cash flow in all the cumulative bucket is positive. In terms of capital adequacy, the Tier 1 capital is 20.33% with a total capital adequacy of 24.05%. Our debt equity is around 4 times. In terms of cost of borrowing, the cost of borrowing for the quarter was 9.82%. The cost of borrowing for March quarter last year was 9.34%. But the better part is the cost of borrowing has remained stable if we compare with the last quarter. We expect cost of borrowing to be around this level in the coming quarter also. One achievement in terms of credit rating upgrade, where the company long-term bank facility and NCD rating has been upgraded to AA- from CARE from the A+. This upgrade in rating will help us our drive to diversify our resource mix, and that too at a competitive pricing. Thank you. So now we are open for the Q&A round. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask questions, please press star and 1. The first question is from Hardik Doshi from White Whale Partners. Please go ahead.
Yeah, hi. Thanks for taking my question. I wanted to just understand on the operating expenses side, the operating expenses had gone up as a percentage of AUM and as a percentage of NI in FY23 because we were investing more into branches, our people, and moving more of the sourcing through our distribution. But since then, it was kind of gradually trending down, but it seems like in the fourth quarter, it has again kind of gone back up on a year-on-year basis. Can you just maybe talk a bit about were there any particular investments or any one-offs here?
See, on cost of operations, as I've been sharing since long that the right way to look at it is maintaining our ROAs. So the cost of operations, once we have our retail at around 70-75% in terms of percentage to AUM will still increase, but at the same time will be compensated by the yields what we will get, and hence our ROAs will remain stable. If you see our ROA has been stable at around 2.80%, reflecting on the fact that the overall ROA dynamics has not been disturbed. And in terms of operations to NII and operations, cost of operations to AUM, I still believe that we are at quite efficient stage despite of the fact that many of the branches are yet to pick up on volumes. So once the branches picks up on volume, but at the same time that efficiency to an extent will be offset by opening of new branches, investment in technology and all. So we see this operational cost at this level or maybe little higher without affecting our ROAs.
Okay. And so I guess that is also the reason why our NIMs have gone up is related to this. NIMs and OPEX are both going up proportionally and ROAs are remaining stable.
Yeah. Yes.
Okay. The other question that I had was that we are continuing to grow our salary personal loans very strongly. How are you seeing the trends out there and the asset quality kind of indicators and any concerns? And second part of that is how much of this is being done through our partnerships with fintechs and how much is being done through our own distribution?
If you think salary personal loan is a new product, a very low base, we continue to maintain that this will be less than 10% of our total AUM going forward. We have maintained this even before the RBI raised the risk weightage for this particular unsecured personal loan. So we continue to maintain that it will be less than 10%. And in terms of our contribution from fintech, I think currently around 35 to 40% of the business in salary personal loan comes through our fintech partnerships.
Sorry, 35 to 40% you mentioned?
Yeah.
Okay. And one last question is, you mentioned that we're looking to do the QIP and you had meetings last quarter, you will continue to have this quarter. But roughly, what is the timeline? Are we looking to do this QIP this quarter or is it open-ended?
It is absolutely open-ended because this is an exercise done very well in advance, not from the statutory requirement or not even from the gearing point of view. But in our next phase of growth, if you look at one link of chain at a time from 10 to 20,000 crores, we thought that some infusion of capital will further strengthen the balance sheet. So it is absolutely open-ended. We'll go on meeting investors quarter on quarter, look at the right set of valuations and the investors and take our decision.
Okay. Thank you.
Thank you. The next question is from Shripal Doshi from Equirus. Please go ahead.
Hi, sir. Good evening and congrats on a great set of numbers.
Good evening.
Sir, my first question was pertaining to the credit rating upgrade, so congrats on that as well. So how do you see that, benefiting us on the cost side going ahead? And while there was this, risk weights increased by the RBI, while that doesn't impact us significantly, but with this, so point number one, that impact, and point number two, this benefit, how should we see, the cost going ahead because of these two reasons playing out?
So credit rating upgrade will definitely help us in the medium term. Majority of our loans are MCLR backed. So we will take this opportunity to renegotiate loans with all our lenders as and when there is a MCLR reset, including our negotiation on rates when we take a new borrowing. So that will kick in right from this quarter. But the overall impact on the cost of fund will take around a few quarters to be reflected in the balance sheet. In terms of credit squeeze, I think if we take it in the right perspective, RBI for companies like us who are mainly into MSME funding and growing cautiously are not against lending to companies like us. Even if you see banks, they are more than happy to lend to the companies who are very consistent in their approach, growing in a calibrated manner. And secondly, all the business what we do falls under the priority sector lending as far as the bank is concerned. So for us, there was no impact of any of the liquidity. As such, there was no liquidity squeeze or credit squeeze, but there was no impact on the RBI commentary from time to time on NBFC. Secondly, with our credit rating upgrade, we will look at diversification of resources. We might like to have more of capital market participation going forward, so as to decrease our dependence only on banks. So within few years, I think capital market, which is currently around 8 to 10%, can be anywhere between 15 to 20%, depending upon the overall market situation. But that will give us an opportunity to have multiple sources of funds.
Funding, right. Got it. So point number two was, I was looking at the number of NBFC tie-ups that we've added during this quarter. While we continue to add organic branches, so we've added some 8-9 branches. We have been proactive on adding NBFC partners as well. But if you look at the split of, this NBFC partner-driven book has come off or has been coming off. So is it fair to assume that our organic lending is at a relatively higher ticket size versus the NBFC partner-driven business?
Not at the higher ticket size. Our organic lending in absolute amount, as I shared, which is now 67-33 or 68-32,
right.
will be around 70 to 75% within the next few years. And we, as I have told number of times, that we have a fantastic experience with our NBFC lending partners too. So we don't mind adding on to new lending NBFC partners as we go forward, because in absolute terms that amount will increase. In relatively, the percentage is a shift from our direct retail to indirect retail, but in absolute terms the amount has to increase. So it is a cautious decision on the part of the company to have more and more partnership, to have limited exposure on each one of them, and have a well diversified asset base there also.
Got it. And so the organic business that we are building, or which we've already done commendable job on, so is the average ticket size relatively higher than the partner-driven business? Like, is it fair to assume that way?
Yeah. In certain product it is. Say for example, in products like MEL, in products like SME, it will be higher. In terms of two-wheeler and SRTO, it will be almost same.
Got it. And see, if you look at last couple of quarters, the calculated yields have come off. So what explains that?
I think you have to go on a product-wise basis, because average calculated yields will not always give the right picture because of so many variations and so many dynamics in that. But if we talk on an overall basis, I think on a consolidated basis we maintain a NIM of 7% at an overall yield, combined yield of around close to 16%. And then we are left, after the credit cost and the operational cost, we are left with around 3.75 to 8% of profit before tax and 2.8 after tax.
Right. Got it. Sir, thank you so much for answering all my questions, and good luck for the next quarter.
Thank you.
Thank you. Next question is from the line of Subhranshu Mishra from Phillip Capital. Please go ahead.
Thank you for the opportunity to be the investor, and congrats on the set of numbers. My first question is partly answered. Just want to understand the NBFC partner sourcing. We've always focused on sourcing MEL and two-wheelers, and I thought that we sourced most of our SME loans on our own. We just wanted that clarity as to how we have structured the NBFC partner sourcing now in each of the products. And if we are doing higher ticket sizes organically, what would be the credit risk and risk management on our own versus partner sourcing? That's my first. I'll come to the second after this one. Thanks.
So in terms of our NBFC partnership, I think they contribute very meaningfully as far as MEL is concerned, to the extent of say around 40 to 45%. In SME, they contribute anywhere around around 25 to 30%, and in two-wheeler and SRTO in line with our overall mix of anywhere between 25 to 30%. So, but for MEL, they more or less contribute equally. In terms of moving on our organic growth and in terms of the risk management, as you know that we have been a company who have believed in growing very cautiously, putting the credit risk and the profitability before just the growth. So if you see our SME portfolio, whereby we have increased our ticket size to an average of 20 lakhs of rupees, the quality of the portfolio has been maintained in the most satisfactory manner. And as and when we increase our ticket size, that will be the endeavor to see to that how the credit quality is maintained, and then go on the growth part on those higher ticket size. So that fundamentals will be observed as far as the operations are concerned.
Understood, sir. And in terms of our borrowing mixture, we still have a significant portion of cash credit or overdraft, which comes in as an expensive way of borrowing. Of course, we might be keeping that to roll over various loans or maybe for working capital. But with this rating upgrade, would we want to retire some of